Inflation has slowed compared to its peak, but for many households, prices still feel high. Grocery bills remain elevated, housing costs continue to pressure monthly budgets, and many everyday services cost more than they did just a few years ago. In 2025, inflation is no longer rising rapidly. However, it is still shaping how households spend, save, and plan. In this report, we explain why inflation remains high, how this environment developed over time, and what it means for household finances. Inflation measures how quickly prices rise across the economy. In recent years, that pace has slowed compared to earlier highs. However, slower inflation does not mean prices have returned to previous levels. It means prices are increasing more slowly, but from a higher starting point than before. This affects food, rent, energy, transportation, insurance, and services. It also influences interest rates, borrowing costs, and pricing decisions made by businesses. These conditions apply broadly across the United States, though the impact varies by region and household. Today's inflation environment developed gradually. It did not appear overnight. Earlier in the decade, global supply chains were disrupted, manufacturing slowed, shipping costs increased, and key materials became harder to source. At the same time, consumer demand returned faster than supply. Labor markets tightened. Many employers raised wages to attract and retain workers. These higher costs became embedded into pricing, especially in service-based industries. Central banks responded by raising interest rates. These actions reduced the speed of inflation, but they did not reverse earlier price increases. As a result, inflation cooled, while overall price levels remained higher. This is where inflation is most noticeable for households. Monthly budgets adjusted over several years. Even as inflation slowed, expenses remained elevated. Food prices reflect higher transportation and labor costs. Housing remains expensive in many regions due to limited supply and steady demand. Utilities and insurance costs have increased in many areas. Wage growth helped some households offset rising prices, but not all incomes kept pace. Higher interest rates increased returns on some savings accounts. At the same time, borrowing became more expensive. Credit cards, auto loans, and mortgages now carry higher monthly costs. For many households, inflation in 2025 feels less sudden, but more persistent. Economists are watching several key indicators: service sector inflation, especially housing and healthcare, labor market conditions and wage trends, consumer spending behavior and credit usage. Some cost pressures may ease gradually over time. Others may remain persistent due to long-term structural factors. Major changes are expected to occur slowly rather than suddenly. For households, inflation in 2025 is about understanding context. Prices reflect several years of economic adjustment. Financial decisions involving housing, borrowing, and long-term planning are influenced by this environment. Understanding why prices remain high helps explain why financial conditions feel different, even when inflation headlines improve. Inflation has cooled, but its effects remain part of daily life. Prices adjusted upward over time, and those changes did not reverse. At VeriScope News, our focus is clarity without noise. We explain what's happening, why it matters, and what the data shows. For calm, fact-based context, consider subscribing.